Martin Marietta, Q2 2026 earnings. They beat consensus across the board. Revenues hit a record $1.947 billion, up 21% year over year. Adjusted earnings per diluted share from continuing operations, that came in at $5, up 3%. Management is actually raising full-year 2026 revenue guidance to a midpoint of $7.3 billion. And they're reaffirming adjusted EBITDA guidance at a midpoint of $2.43 billion. And, the stock traded slightly up in the after hours following the print.
Right. And I mean, looking strictly at those headline figures, the momentum is pretty obvious.
Yeah.
But our objective today is to really bypass that whole top line glare. We have to dissect the underlying segment performance, filter out some really deceptive margin noise that's being driven by recent acquisitions, and critically evaluate this massive, $13.5 billion pivot into a completely different asset class.
Which is huge.
Exactly. Because that is really the only way for you to gauge how this company is actually positioned to execute in the back half of 2026.
All right, so let's start with the volume in their core aggregates segment.
Oh.
The crushed stone, sand, gravel, all the stuff used in heavy construction. It is massive.
Yeah.
Shipments jumped 17% in the second quarter.
Yeah, to a record 61.6 million tons.
61.6 million tons. Granted, that includes a full quarter of the recently acquired Quikrete assets and a partial quarter from the new Frontier Materials deal, which closed back in May. But still, pushing 61 million tons of rock through a distribution network is just a logistical feat. But as we know, moving volume alone doesn't pay the bills.
No, it doesn't. And that brings us to, honestly, the most scrutinized part of this entire report, because the aggregate volume is kind of masking a pretty severe margin squeeze on paper.
Yeah.
Which means we really need a closer look at the accounting mechanics here.
And that is exactly the red flag that I think retail investors are zeroing in on right now.
Mm-hmm.
Because if you move down the income statement, the average selling price, the ASP, it dropped 2% to $22.74 a ton. And gross profit per ton, that actually fell 17%. So the immediate question you have to ask is whether Martin Marietta is sacrificing their pricing power just to, pump out more volume and justify these recent acquisitions.
Well, yeah, that is the logical assumption to make, but it fundamentally misunderstands how generally accepted accounting principles, GAAP, actually dictate the reporting here. They haven't lost pricing power.
Okay, so what's happening?
The GAAP metrics you're looking at are being heavily distorted by a mix headwind and a mandatory one-time accounting adjustment.
Okay, let me just play devil's advocate for a second to try and translate this for you. Let's say I operate a premium bakery, right? And I sell these $10 artisan croissants.
Okay, I'm following.
And then I acquire this giant discount bread factory that just pumps out $2 loaves of bread. Suddenly, my overall volume skyrockets. But because I'm suddenly selling thousands of these cheap loaves, my average price per item across the entire company just plummets. But I haven't lowered the price of my croissants, right? I might have even raised them to $11. So my core pricing power is totally fine. Is that essentially what is happening here with this mixed headwind?
That is actually a really accurate parallel. So Martin Marietta acquired assets, specifically out in their Central and West divisions, that historically just sell aggregate at a structurally lower price point than their legacy business.
The discount bread.
Right, the discount bread. So when you blend those new lower price tons into the consolidated financial statements, well, the overall average price drops 2%. But, and this is the key, when you isolate the legacy business and just look at the organic mix-adjusted ASP, it actually increased by 3.7%.
Okay, wow. So they are still pushing through nearly 4% price increases on the legacy rock they were already mining.
They are. The core pricing strategy remains totally intact. But now, looking at that 17% drop in gross profit per ton, we really have to isolate this $52 million non-cash charge.
Ah, yeah, I saw that.
Yeah, it's related to the purchase accounting inventory step-up.
All right, I saw that charge buried in the footnotes. Let's break down the mechanics of why that happens, because it's kind of a classic post-acquisition distortion, isn't it?
Oh, absolutely. So when a company closes an acquisition, accounting rules mandate that you have to mark up the acquired inventory, so the physical stockpiles of rock that are already sitting at the newly bought quarries.
Like the rock that's already out of the ground.
Yes. You have to mark it up to its fair market value on the balance sheet. Consequently, when that specific pile of rock is finally sold in the current quarter, the associated cost of goods sold is artificially inflated to match that new fair market value.
Got it. So it effectively just wipes out the margin on that specific inventory.
Temporarily, yes.
Yeah.
It compresses the gross margin for the quarter that it sold, but you have to remember, it is a non-cash accounting adjustment. It has absolute zero impact on the actual cash generated by the underlying mining operations going forward.
Which really highlights the danger of taking top-line margin figures at face value, without reading the footnotes. And parsing the cash costs even further, I noticed their organic cost of goods sold per ton, it only rose 3.6%. And that figure absorbs a 150 basis point drag. So like a 1.5% hit just from higher external freight costs.
Yeah, to keep core production cost inflation essentially near 2% while you're absorbing those significant freight pass-throughs, that really demonstrates rigorous cost control at the plant level.
Yeah, for sure.
Mining and transporting heavy materials is just incredibly energy and logistics intensive. Managing those variables effectively, that's what protects the margin baseline in a high inflation environment.
Okay, so the core aggregates engine is humming, albeit, heavily augmented by these bolt-on acquisitions. But they are moving way beyond bolt-ons now.
Very much so.
Because on June 27th, they announced a definitive agreement to acquire Lois North America, or LNA, for approximately $13.5 billion in cash and stock. And this fundamentally alters their capital allocation strategy.
I mean, it is a massive check for 20 lime quarries and 45 distribution terminals. This transaction establishes Martin Marietta as the dominant lime and limestone producer in the country overnight.
Yeah, and I look at a $13.5 billion outlay, and I just have to ask if this is classic diversification. Because investors pay a premium for Martin Marietta because they operate this near oligopoly in local crushed stone markets.
Right. They own the local markets.
So diverting that much capital into a completely different material class, it just seems like a massive distraction from their core competency.
I mean, it's a fair, skeptical take, but I think it ignores the strategic roadmap management has been telegraphing for years. This acquisition is basically the anchor of their SOR 2030 objective.
The Strategic Operating Analysis and Review.
Exactly, which explicitly targets expanding their upstream specialties platform.
Okay, and the Specialties Division, that currently houses their existing magnesia and dolomitic lime products, right?
Correct. And the rationale here is really all about scarcity. High calcium, long-lived limestone reserves are just notoriously difficult to permit and bring online in today's regulatory environment. It's almost impossible.
So it's a land grab.
Essentially, yes. By acquiring LNA, they are locking down irreplaceable geological assets, and they project this combination is going to increase their 2026 specialties revenue by roughly 25%.
Right. But, scarcity only matters if the underlying demand is actually durable. Like, why is lime superior to just acquiring more granite reserves for traditional road construction?
It provides a fundamental shift in their end market exposure. Aggregates are heavily tied to the cyclicality of residential and commercial construction, right? Housing starts go down, rock sales go down.
Right.
Lime, however, is consumed across a highly diverse industrial base. We are talking about water purification, steel manufacturing, environmental remediation, agriculture.
Okay, so those are continuous industrial processes.
Exactly. So, for example, in steelmaking, lime acts as this critical flux to remove impurities like silica and phosphorus from the molten metal. You have to have it. And in municipal water treatment, it is used literally daily to adjust pH levels and soften the water supply.
They can't just stop buying it.
No, they can't. Those industries require a continuous feed of lime regardless of whether housing starts are up or down.
Which explains the historical resilience they cited in the earnings materials. I mean, they noted the legacy Woodville Lime RSP showed a 2% compound annual growth rate from 2006 to 2025.
Right.
And that period obviously covers the massive 2008 to 2010 housing crash.
Yeah, while the aggregate side of the business was seeing volumes just plummet during the financial crisis, the lime market held its pricing and volume relatively stable. The end uses for lime just do not shut off during a recession, so adding LNA creates this massive structural shock absorber for the broader balance sheet.
Well, and the numbers in the current quarter show the specialty segment was already accelerating even before LNA was announced. Q2 specialties revenues hit a record $152 million, which is up 68% year over year. And gross profit reached $50 million, a 39% increase.
And a significant portion of that growth stems from the Premier Magnesia acquisition that they integrated back in 2025, layered with their organic pricing power. It really provides a proof of concept to the market.
Like a trial run.
Yeah, exactly. Management has demonstrated they can acquire specialty chemical and upstream assets, integrate them, and drive margin expansion. LNA is simply the supersized version of that exact playbook.
But executing a $13.5 billion transaction and funding it by debt and newly issued stock, that puts tremendous pressure on the balance sheet. To justify that kind of leverage, the existing operations have to run incredibly lean.
Oh, absolutely.
And management clearly recognizes this because they just announced an expanded enterprise review identifying roughly $350 million in annualized cash flow improvements.
Right. They are systematically scouring the legacy business to free up the cash necessary to digest this incoming asset base without blowing out their leverage ratios.
It feels very analogous to, like, a homeowner doing a severe budget audit. They cut every streaming subscription, they aggressively renegotiate their auto insurance, they strip their monthly overhead to the bone right before taking out a massive second mortgage to build an addition. You have to tighten the belt before taking on the debt.
That comparison is incredibly apt. But what gives this credibility is that the $350 million is not just some aspirational target drawn up by consultants on a whiteboard. They're actively executing on optimizing their network footprint, shutting down redundant distribution facilities, and severely curbing non-essential sustaining capital expenditures.
Yeah, and we're already seeing the cash materialize. They've unlocked over $200 million in cash year to date compared to 2025, largely by just throttling down inventory builds and cutting capital spending.
It is a totally necessary culture shift. When you acquire massive asset bases like Quikrete, New Frontier Materials, and soon LNA, you inevitably inherit a lot of operational bloat.
Yeah, duplicate managers, extra trucks.
Exactly. Identifying and extracting that $350 million proves they are focused on integration and actual efficiency, not just top-line empire building.
But identifying $350 million in savings on a spreadsheet is very different from executing it in the real world. To see if they can actually pull this off, you really have to look at how they manage the chaos on the ground. And that brings us to a very surprising metric that CEO Ward Nye highlighted, which is safety.
Yes.
He noted this is the safest first half in company history for total injury and lost time incident rates. Now, beyond the obvious human element, which is great, why does the financial deep dive care about safety rates?
Well, in heavy industrial sectors, safety is really the purest leading indicator of operational excellence. A quarry with a poor safety record is fundamentally out of control. Lost time incidents result in halted production, delayed logistics, spiking workers' comp liabilities, and, regulatory intervention from agencies like MSHA.
So a pristine safety record implies a highly standardized, predictable operating environment.
Precisely. You cannot extract $350 million in efficiencies from a chaotic system. The safety metrics confirm that site managers have really tight control over the daily variables, which is the absolute prerequisite for executing complex financial and operational optimizations.
That makes total sense. But okay, all of this optimization and expansion assumes the demand will actually be there to absorb the new capacity. Looking at the safe harbor notes, I am seeing major red flags regarding high mortgage rates. If private residential construction stalls out, they lose a massive outlet for aggregate volumes. Aren't they walking straight into a demand trap?
The residential slowdown is definitely a tangible threat. Management openly acknowledges that elevated mortgage rates are a headwind suppressing single-family housing starts. And consequently, their reliance shifts really heavily to State Department of Transportation budgets.
Right, the DOT.
Yeah. If state tax revenues decline and DOT budgets contract, Martin Marietta feels that contraction directly.
And furthermore, you have the LNA transaction risks themselves. Securing regulatory approvals for a market-dominating merger is never guaranteed. Plus, you've got the diversion of management focus and the dilution to existing shareholders from issuing new stock to fund the purchase.
Those are all the variables that could absolutely compress the stock's multiple. The analytical pivot here is determining what structural forces are currently counterbalancing those cyclical risks.
And the immediate counterbalance is the Infrastructure Investment and Jobs Act. There is approximately $350 billion in IIJA funding still available to flow into the market.
Yeah.
And what's fascinating is Martin Marietta is geographically insulated. 60% of the U.S. population and 80% of projected population growth through 2050 is within 60 miles of one of their facilities.
That 60-mile radius is the critical competitive moat here. Aggregate is extremely heavy, and it possesses a very low value-to-weight ratio.
Right, it's just cheap, heavy rocks.
Exactly. Transporting it long distances via truck completely destroys the profit margin. So controlling the local supply within a 60-mile radius of major demand centers gives them ultimate pricing power.
Even with the geographic advantage, though, I am pretty hesitant to underwrite a thesis reliant entirely on government infrastructure bills clearing smoothly.
Yeah.
I mean, what happens if federal spending hits a bottleneck in Congress?
Well, they aren't solely dependent on the IIJA. The heavy non-residential sector is just surging right now, effectively offsetting the weakness in light non-residential areas, like office and retail construction. We are tracking immense capital flows into power generation, warehousing, and most critically, data centers.
Okay, yes. The data center exposure is the hidden variable here.
Yeah.
The Kansas City region was specifically called out in the materials. 6 data center projects are currently being supplied just by Martin Marietta's Central Division alone.
Because data centers require colossal amounts of aggregate. You need massive, heavily reinforced concrete foundations to support the immense physical weight of server racks.
They are so heavy.
Right. And beyond the footprint itself, you have extensive concrete infrastructure required for the industrial cooling systems, massive chiller plants, subterranean water conduits, and heavy-duty retaining walls. That all requires specialized, high-grade aggregate mixed right into the concrete.
Which perfectly aligns with the reindustrialization data they cited from the Dodge Construction Network. Get this, 70% of planned or under construction data center square footage is located within 55 miles of a Martin Marietta facility.
It's staggering.
70% is a massive concentration. It means their geographical footprint isn't just a happy accident. It's a direct bottleneck for the AI build-out.
And it extends beyond just data centers. 80% of planned warehouses, 70% of planned manufacturing square footage, and 50% of energy projects sit directly in their geographic strike zone. These are highly concrete-intensive mega projects that require stable, local aggregate supply chains over multi-year timelines. When you aggregate all these end markets, it forces a complete reevaluation of the company's core identity.
It really forces a completely different framework for how you value the equity.
It should absolutely change how investors model the stock. I mean, the market historically treats aggregate suppliers as these slow-growth, cyclical rocks and roads plays, a standard infrastructure stock. But when your footprint captures 70% of the domestic data center pipeline and half of the national energy projects, you are fundamentally decoupled from just filling potholes.
Yeah.
They are basically positioning themselves as a backdoor pick-and-shovel play for grid modernization and the artificial intelligence infrastructure boom.
Because you cannot build the cloud without moving the earth first. Something for you to keep in mind the next time you see a supposedly boring rock quarry on the side of the highway. That's our deep dive for today. Hit that follow button for your daily no-nonsense earnings report coverage.